We're here to talk about Silicon Valley real estate market geographically and graphically, and actually some tables. We're talking about the Greater Bay Area, 13 counties and 5 regions. That's week number 49. I'll explain the URLs at the end. I'm Richard Calhoun, broker with Creekside Realty. Been working with buyers or sellers in Silicon Valley since 1981. Happy to work with you. Here's the slides that we're going to be going over. If you're a visitor, you may want to just jump right through to the first data slide and skip this introduction. Basically, there's some very unique features that I'm doing. I do everything a little bit different. I don't look at monthly data. I look at weekly data. I group 5 weeks to get to monthly data. I look at 13 weeks to get quarterly data. I'm looking at the different micro market areas because the real estate marketplace varies. I'm looking at the price reductions sellers are taking. I'm looking at overbids. Here is an article that came out this week that someone pointed out to me. The article is basically 2 counties, San Mateo County and San Francisco County, have the most sellers upside down in the Bay Area, and it may have even been in the nation. And then when you read the article, they were actually blaming that on the interest rates. Well, interest rates is going to impact all the areas the same. They're not going to single out 2 counties out of 9 counties that they were talking about. They were talking about the 9 counties that touch the Bay. The reason those 2 counties are doing the worst is directly related to the pandemic and not interest rates. With that, let's get into the data. You can pick your favorite metrics. You can pick the micro market on the left-hand side that you want, see what the market conditions are, come over here and look at the payment you can afford, come back, figure out what micro market area that is and the market conditions. So here's the first micro market map. What you're seeing here is the active listings compared to the 10-year normals. We look at what the active inventory has been for the past 10 years for the same week of the year. And the week of the year, we start on March 1st and then go forward every 7 days. But then we work backwards to January 1st to get the first week of the year. The active listings basically are short, running right around 3/4 in Santa Clara County, and in Alameda County, I only have county-wide data. I list the micro market areas on the right-hand side here, but it's county-wide data for that particular geographical area. And that's true for the first 3 or 4 slides. But in Santa Clara County, you can see you vary from basically 111% in Cupertino, Sunnyvale down to 55% in Milpitas, Blossom Valley areas. San Mateo County is definitely a little bit more inventory. Basically, all the areas except for Redwood City are slightly above 100% of what you'd expect it to be. Foster City, I sort of ignore. It's a unique, very small market, so it varies dramatically from week to week. And then you have the North San Mateo County that's just under 100%. Now we're flipping over and looking at the same thing, but we're looking at the number of offers. Here, the number of offers are below what you'd expect them to be. And because the number of offers are below what you'd expect them to be, that favors the buyer, less competition, sellers get more motivated, and therefore the blue colors on the map. And again, you can see Alameda County's county-wide data at 71%. Santa Clara County is mostly right around 50 to 80%. And San Mateo County is right around actually 50 to 100% as well. The big takeaway here is the sort of the west port of the valley. It has sort of the normal amount of offers being accepted. Everywhere else has a lack of offers being accepted. Here's the DUI compared to the 10-year median. So now I'm looking at the DUI itself for each of the past 10 years for the same week. I look at week 49 for the past 10 years and compare the current data. The one exception, again, is Foster City, Redwood Shores. But again, that's a very small micro market and it's going to statistically fluctuate all over the place. Now we're looking at the current DUI by itself. Now I do have data for Alameda County for each one of the micro market areas. And I'm just looking at what the DUI this week was. And you can see in Santa Clara County, we have some very active areas. The moderately affordable areas of Blossom Valley, Milpitas, Berryessa, Santa Teresa, as well as Santa Clara, Willow Glen, Cambrian, and Campbell are sort of the more active areas. Your more affordable areas, be it South County or East San Jose, South San Jose, downtown San Jose, they're around 50 days. I consider basically somewhere between 40 and 80 days to be balanced marketplace. It depends on if I'm talking about pure days or weeks. Down here, most of the focus is weeks. So basically anything under 6 weeks, 42 days, I consider to be sort of a seller's marketplace. Anything over 11 weeks, I consider to be a buyer's marketplace. Here's looking at a metric that's a lot easier for the layperson to understand. Just how long is the long typical seller taking to sell their property? This is the seller that comes on the market, doesn't underprice their home, their property, they're listing to get it sold immediately, but it's on the market, and 75% of the sellers are selling as quicker than he is, and 25% of the sellers are taking longer than they are to sell. And this is just the time frame. You can see that most of the areas are basically in the just over 3 weeks to just under 7 weeks, somewhere between the 3+ to 7- range of weeks. 22 to 48 days is sort of the balanced marketplace. You can see that a lot of the areas in Santa Clara County are right around 25 to 40 days. You can see that Cupertino Sunnyvale is just over 2 weeks. The slowest area is the San Mateo County coast, followed by the San Mateo County expensive areas. But in general, we got a fairly balanced marketplace with not a whole lot of slow areas. With the exception of the San Mateo County coast, everything in Silicon Valley, all 3 counties, would sell out in under 2 months. Well, they wouldn't sell out, but everybody that's serious about selling their home, 75% of the sellers that try can sell their home in that time frame. But it's also only the successful sellers. The sellers that come on the market that overprice their property, that will never sell, aren't included in this, because it only comes in, you only know the days on the market when the offer comes in. I don't add in the days on the market on those properties that go off the marketplace, because they're not really reflective of the market. Now we're looking at a fairly unique metric that I don't know anyone else that follows. And this is simply how much is this average seller reducing their asking price. And I am going to change the spread on this probably over the holiday weekends. Basically, what you're doing is looking at all the sellers in a blender for the micro market area. How much are they reducing their price? And you can see that we're going up to about 5% reduction. And that doesn't sound like a lot, but the reason that's not a lot, but still significant, is many sellers do their homework before they put the house on the marketplace and price their home accordingly. And if you're selling your home in 2 or 3 weeks, you don't even have time to consider a price reduction, frankly. And so the vast majority of the sellers don't do their price reduction at all, which is why the average reduction is so small. Here we're looking at the frequency of those reductions. How common are the reductions? And you can see that it's very unusual. In fact, I'm not seeing any number on this entire chart above 33%, with the exception of the San Mateo County coast, which is approaching 50%. You basically are pretty much less than a third of your sellers are taking a price reduction at the time of the year where price reductions are not uncommon. And the reason price reductions are not uncommon at this time of the year is the market tends to slow down, and sellers have been on the marketplace, have seen what the market's been doing, and don't realize on the market slows, and the market slows rapidly, and then they have to adjust their price to try to chase the market down. Now we're flipping over and doing the same thing. We're going to look at the average overbid. How much are buyers overbidding the property when they come in? And you can see the San Mateo County coast is a 2% reduction. And then you can see Redwood City, for example, is a 2.7% increase. And you come down to Oakland and Berkeley, and they're sort of standouts, especially Berkeley's a little over 16% overbid. So if someone's asking $1 million, you come in at $1,160,000 on your asking price on average. So there's some buyers that are going to come in even higher than that 16% over. And of course, there's some buyers that come in at 1% over, and there's some buyers that probably come in at 99 or 95% of the seller's asking price. Now we're looking at the frequency of the overbids, and you can see again, San Mateo County coast really stands out. Only 1 in 4 sellers gets more than their asking price on the coast. 1 in 3 in South County. Everywhere else is basically 1 in 2 to 3 out of 4. It is pretty aggressive. In fact, that come down out of Berkeley here, it's 4 out of 5 sellers are getting more than their asking price. Why was I commenting about Berkeley earlier? Even though Berkeley right now is having a lot of overbidding frequency and magnitude, it's got one of the lower appreciation rates at 41%. Now, granted, it's not as low as Los Altos and Palo Alto at only 18%, or the Bay Cities at 21%. And these numbers vary a little bit, and more than I would have expected based on what's selling. But you can come down into Santa Clara County and you can see a lot of the areas are right at 80%, especially the affordable areas. And that's what the story is right now. It's about affordability. If you look at this, even in Alameda County is more affordable, and it's got some of the highest appreciations overall. And so the red color here is not favoring the seller, but it favors the seller in the fact that it's got the greatest appreciation. The outlying areas, and if you start looking at this, if the job centers are over here on the peninsula, where people used to pay a premium to be close to work, and now we have the pandemic where people don't have to go into work as often, you can see why the outlying areas that now don't have as much of a negative associated with them are appreciating the most. Here's the sold price. The middle number is the median price. And instead of quoting just the median for a given area, I quote the 10th percentile, the cheapest home you're likely to find in the area, and the 90%, the most expensive home you're going to find in the area. If we pick Cambrian, Campbell, Willow Glen, and Santa Clara, you can see that the bulk of the homes, 80% of the homes go from 1.3 million to 2.4 million. You got a range of 1.1 million roughly. And the middle point is basically just shy of 1.8 million. It's only 400,000 from 1.3 to 1.4, because both of these are about 50s. $400,000 has 40% of the homes. But then the next 40% of the homes is basically somewhere approaching 650,000, an extra $250,000 to get the same 40%. And that happens because of the bell curve. As you get to the low end, it's the land that's the valuable, and as you go up in price, you start getting more and more house for the same incremental dollar amount, and the prices just go way up. Here's a summary that we went over. So you have the different metrics. Each one of these columns is a map that we went over, and then the color code is basically whether it favors the buyer or the seller. And then you have the actual raw data. And over on the right-hand side, I have the payments, and that's just using the Federal Reserve jumbo money out of St. Louis for the nation and going through, assuming everybody's doing an 80% loan. So you can see the lower priced areas are more affordable, and it's going to be directly related to the price, which is why I don't have a color off to the right-hand side. It would be identical to the price. Now we're looking at all of Silicon Valley instead of micro markets in a blender. What's going on? The purple line is your inventory, and we have 86% of the inventory that you normally would expect, but we only have 73% of the offers you'd expect, resulting in a slower market with a DUI of basically 109%. And to me, the big takeaway here is look at the increase in inventory. Since basically somewhere around August the 1st, inventory has just been basically going up. And we got down to less than 60% of the inventory you'd expect to have, somewhere around 58%. And we've gained basically 30% of your market inventory in something approaching 4 or 5 months, which is pretty significant. This table's up here for basically the last line. And what we're doing is we're saying that 2022 was the worst year in the last 25 years. Now we're the 24th out of the last 25 years. And what you're really looking at is not very much difference. You're looking at last year we sold 1,347 homes, and this year we sold 1,377. These are offers accepted. So even though these numbers have not been dropping very much, it is possible with additional time the 1,377 of this year will decrease. I normally would have thought it would get down, we'd lose 30 transactions, but that really hasn't been happening. I think part of the reason is, as I look at the Silicon Valley as a whole, there's more late reportings in some of the areas than I'm used to. Here's looking at the monthly estimated payments. And what we're doing here is we're just taking the 10 percentile for Silicon Valley. And if you bought the 10 percentile home in Silicon Valley with an 80% loan, what would your monthly PITI payments be? And I get $7,100 a month. If you bought the median home, you'd be at $12,500. And if you bought the most expensive 90% home, you'd be up here at almost $26,000 a month. Now, typically the person that's buying the most expensive home is not getting an 80% loan, but that would be what their payment would be if they did get an 80% loan. And you can see that payments were basically fairly flat for a long period of time. And then starting with the pandemic, we've been basically on a climb. This initial climb was because of home price appreciation, and the more recent climb is because of interest rates. So even though interest rates have gone up by a factor, basically a factor of 2, doubling, your mortgage payment has not doubled from 10,000 to 20,000. It's only gone from 10,000 to 12,500. Combination prices are a little bit lower. Also, your property tax, which are a significant percent of your payment, is fixed based on the purchase price. Your insurance premium is pretty much fixed. And then as your interest rates go up, the amount of principal you pay each month goes down. So your mortgage payment doesn't even go up linearly with interest rates. So if interest rates double, your mortgage payment doesn't double. Might be interested for me to do that calculation and show that next week. I'll try to remember to do that. Now we're looking at something that's also unique to my data set as far as I know, in addition to just the speed, since this data is accurate as of Friday night, last night, midnight. Nobody turns the data that quickly, and it's so hyper-focused just on Silicon Valley. But here what we're looking at is the weekly distribution. The purple line is the current week, and what we're doing is starting off 12 months ago, which is this blue dotted line down here. And what we're going to do is step through roughly a month. And the reason I say roughly a month is I believe that you want to avoid calendar months and look at whole weeks. So I jump back 4 or 5 weeks, trying to keep the date as close to the 9th of the month as I can. And this is simply the distribution. So the dotted line here says 5% of the sellers were taking a 14% price reduction. They were getting 86% of their price that they were asking. 15% of the sellers were coming up here and taking a 9% price reduction. That was a year ago. Now the purple line is the current line. So we'll pick 10% of the sellers right now are getting 93% of their asking price. And up here, you're getting 15% of the sellers are taking a 4% price reduction. This is the price reduction that sellers take prior to the offer coming in the door. Now we're stepping through, you can see it's going up. That's the spring rush. That's the peak. Now you can see that we're starting to come down, but you have a big plateau during the bulk of the spring and summer months. And then recently you can see the downtrend there, and that's going into the end of the year holidays. We're going to go down a little bit more, I think. And, a year ago we were quite a bit lower, but if we had each week, like the next couple of weeks, the data will most likely be lower. And that data from a year ago isn't there, because to go through 52 slides would take far too long. Now we're flipping over and looking at the same thing on the seller side. What do the buyers come in when the seller's accepting their offers? Here is the overbid distribution, and this is the best line we've ever had. This is the worst week we've ever had. This is where we were a year ago. Remember, this is lagging the market by about 5 weeks because of the length of close of escrows. There's the bottom. Now you're accelerating, and the market's a lot more stable at the higher end up here on the price. And I'm not quite sure why, but it's more stable than the asking price. But you can also see the downward trend now for the last couple of weeks, up, 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 right there. So that's sort of where the market probably, even there, starting around November the 8th, that looks like it stepped down each week a little bit. And, not a huge step down, but definitely a noticeable trend. Now we're looking at the inventory for Silicon Valley compared to the 10-year normal. And we're looking at it, so the 10 percentile down here is the least amount of active inventory, the red line, the thin red line. The thin gray line is where you'd expect the market to be, And then the blue line is where the market would be with the most inventory. This is a 10-year plot here that repeats because I only have 10 years worth of data. And then the purple is the current data. You can see that we're basically having the least amount of inventory that you'd expect. We have exactly 100 more listings than the least we had at 1367. Now, when I keep saying the least, it's just the least that you'd expect because it's 10 percentile. So you clearly had periods where you were lower than the red line. For example, coming back here to 2021, the least you'd expect is the red line way up here, but yet we had so much buying activity and so few sellers, the purple line was significantly lower. Now the purple line is just above the least you'd expect. Flipping over and looking at the number of offers, same thing, but now blue is on the bottom because a low number of offers favors the buyer. Here you can see that we almost have identical. It looks like the numbers are 1375 is the least you'd expect, and the number we have is 1377. This particular week, we'll only have 90% of the 10-year inventory, or we only have 10% of the 10-year inventory that you expect. Note how rapidly all three of the lines are coming down. You can see the end of the year impact. That's why I think it's so important to look at weekly data. One of the reasons I don't want to look at monthly data is monthly data varies depending on what day of the weeks the first is. How many days are Sundays? How many days are weekdays? That impacts your number of closings. The end of the month, a Wednesday, where then you're going to lose a lot of people closing on the first and the second because they can do it in the same week and things like that. Where if you have the end of the month on a Friday, people tend to rush to get into their house on the weekend, and you have more closings on Friday than you do on Monday and Tuesday. Now you're looking at the days of unsold inventory. So now we're looking at the ratio of those, and you can see that the ratio, it typically falls down at this time of the year, and we are falling down. And we actually even have a little bounce here, which is Thanksgiving. Holidays have a huge impact on the data. And one of the things that's sort of interesting is a fair number of your holidays are paced at about a 5-week interval. It's just the way it works out. It's not exact, but it's closer to 5 weeks than it is to a month. Here is your typical compared to normal. So the DUI, the purple's the varying. If we were having a completely normal year, you'd be right on the black line. We went from a faster paced market, a lower DUI is a faster market, which is why the red line is down at the bottom. Now we're at 109% basically of the DUI. So we have an extra 9%, and that favors the buyer ever so slightly. Here's that more easy to understand metric of days on the market for the long typical seller. The fastest marketplace you'd expect is 18 days. We're at 24, so we're 6 days above it, but we're 10 days below the typical marketplace. We're closer to a fast marketplace than we are to the typical. And in a cool marketplace at this time of the year, the successful seller is doing it in 38 days. So here is the graph showing the percentage compared to typical. And now this has been going down where the market is accelerating compared to where it normally goes. And frankly, based on the previous slide, it's slowing down at a faster rate to have this number coming down. And it's actually been level since the beginning of fourth quarter. The decrease was basically from the beginning of second quarter steeply through the beginning of third quarter, less steeply from the beginning of third quarter to the beginning of fourth quarter. And the beginning of fourth quarter is basically flat with some fluctuation. If you compare this slowdown here to the typical, these lines since the beginning of fourth quarter are staying on the same percentile. Now we're looking at the average list price reduction. This is how much is the seller doing it. This is the average. You can see it's a very small number decrease, only a 1.4% decrease, with a 1% decrease being a normal. The range is only from 99.8% to 97.4%. And that's why I sort of call this a tight metric. But what we'll see now is if we look at the seller that's taking the largest 10 percentile, the numbers are much greater and gives you a better sense of what's going on. because now instead of looking at all 100% of the sellers, I'm only looking at the sellers that are taking the biggest price reductions. Right now, 10% of the sellers are taking a 16% price reduction. The most price reduction you'd expect them to be doing is 17%. Typical is a 12% price reduction. In a hot marketplace, they'd be taking a 10% price reduction. That basically tells you that in a hot marketplace, the sellers do take price reductions even though it's a hot marketplace. And that's the 10% that are testing the market, the 10% that misread the marketplace, the 10% that maybe didn't sell for any reason and need to sell. Here you can see that again, the 10 percentile compared to normal. And right now it's increasing. We're basically saying the price reductions are 32% more than normal. And that increase happened very quickly at the beginning of the fourth quarter. We're looking at the frequency of ask price reductions. How common are those ask price reductions? And we're basically right on the typical. Typical is 19.6, we're at 19.5. That's saying that no more sellers than normal are reducing their price right now, but they're taking bigger price reductions than they typically do. Now we're looking at the frequency of those price reductions, and you can see that we're looking at the frequency of those price reductions, and you can see that we're at 98.1% of typical. So we're essentially having a typical marketplace. You can see we started off the beginning part of this year favoring the buyer, the blue color. Then basically we started in the beginning of second quarter, we fell off a cliff through second quarter, beginning of third quarter, we came down, but not dramatically as much. And then basically at somewhere in the middle of third quarter, we started increasing and having more price reduction. We're basically right now at normal. Here we're looking at the average overbid. This is where buyers are coming in and overbidding. Even in a cool marketplace, we tend to have a 2% overbidding, which is sort of almost bizarre, but that just shows you how unbalanced the real estate supply demand curve is. In a hot marketplace, we're up there at 8% over, not 8% overbidding, but buyers coming in on average 8% above. That means that when you put in all the offers that came in, on average, including the ones that were at asking or below asking price, on average, the sellers got 8% more than they were asking. Right now, we're at 4.5%. Typical for this time of the year is 3.9%. Even though we're having more price reductions on the seller to get the offer, when the offers come in, the magnitude of overbidding is slightly greater than it typically is for this time of the year. Here's the frequency of overbidding. You can see we're at 59.5%. Typically, we're at 57.7. We're about 2% more overbidding, and this is frequency. So it's more common right now. In a cool marketplace, you're just under 50%. In a hot marketplace, you're at 3/4. Right now, we're just at 60%. We're right in between the two. And that's what, we happen to be almost on top of the typical marketplace. Now we're looking at the long-term appreciation on logarithmic scale paper. You can see the median for Silicon Valley is $1,473,000. We're getting to be a little bit below where you'd expect it to be based on the rate of appreciation. But you can see at the end of every year, there's a downturn in the value of pricing. And this is a combination of actual value decline, but it's also the type of properties that are selling tend to be smaller homes in more affordable areas. There's a whole shift in the market, all associated with the end of the year holidays, that brings down the median price more than the property values. Now we're looking at the three counties individually. We started off and we looked at the micro markets, then we looked at all of Silicon Valley. Now we're coming back and trying to look at countywide data. And this is just to give you an overview and also to compare to what you might be reading in the paper. San Mateo County is the smallest area in the orange here with 338 current active listings. Santa Clara County is currently next with 502 in the blue, and Alameda County has the most listings at 608. You can see how much Alameda ran up and then came running down in active available inventory. And you can see the huge annual cycle. No matter what your inventory for the year has been, there's a huge end of the year plummet. We're going into the time of the year where you have the least inventory to pick from. Here's the number of offers, and the offers go down at this time of the year. Real estate's an optional event, and I'm even seeing that with the views on my YouTube channel on the archive of this recording. The number of people that have been watching that has dropped for the last 2 weeks fairly significantly. People just get distracted with other things going on. San Mateo County has 280 sales. Santa Clara County has 535, and Alameda County has 562. Days on sold inventory. Santa Clara County is the fastest area at 34, followed by Alameda at 38, and San Mateo County is the slowest at 42. Here's the time on the marketplace, the same order, just a different metric measuring essentially the same thing, the speed of the marketplace. 75% of the sellers are selling in this time frame. You can see going from Santa Clara County to San Mateo County is a huge difference. It's just going from Palo Alto or Sunnyvale into Redwood City, but it makes a big difference. In fact, I've now sold a couple homes in San Mateo County to clients that were convinced that they were getting better values for their money in San Mateo County than Santa Clara County. This is the magnitude of price reductions. San Mateo County is doing the most. On average, the sellers there are taking a 2.4% price reduction to get the offers to come in the door. In Santa Clara County and Alameda County, you're basically at 1.1 and 1.2%. Frequency of that price reductions, you can see over 1 in 4 sellers are taking a price reduction in San Mateo County, 27%. It's basically 17.6% for both Santa Clara County and Alameda. The numbers were identical, which is why only one number is showing there. Here is the overbid magnitude. This is how much buyers are overbidding. Even though San Mateo County is a slow marketplace, almost 3% overbid from the buyers, 2.7%. Santa Clara County is 3.5% overbidding, and Alameda County is 6.4% overbid. This is the frequency of overbidding in a low of from 52 in San Mateo. Santa Clara County is the next at 57% essentially, and Alameda County is the standout at 65.9%. Alameda County, from what I can tell, it's frequent overbidding, but the overbidding is a little bit more restrained, all still significant. Here's the appreciation. Santa Clara County has had the highest appreciation at 77% since 2015. Alameda County is second at 65%, and San Mateo County is in third place. And you can see the fairly rapid drop in San Mateo County at 50% appreciation since 2015. You got a 50% return on your money. And if you put down only 20%, that you've gotten 250% return on your down payment money. Here's the price that we're currently looking at. You can see that Santa Clara County is almost the same as San Mateo County. There's only $24,000 difference between the median price between the two counties. Very close together. Horizontal line is just so you can come back to see that Santa Clara County now is basically at the same level they were in 2021. San Mateo County is significantly below where they were in 2021. That ties into, the San Mateo County being that one of the two counties, San Mateo and San Francisco, that had the most number of sellers that were currently selling for less than they had purchased. Because in San Mateo County, any seller that bought with the orange line above the current orange horizontal line would be selling at a loss today. The only time since February of 2021 where the seller might be able to sell for more is down in this little dip, but that's because we're going to go down a little bit dip further. In Santa Clara County, you only have a little bit of time in 2022 and a little bit of time in 2023 where the price is the same. This is a graphical explanation of that article that we started the presentation with. Same information, just on regular paper for those that prefer. Here's your payments in San Mateo County, very close to Santa Clara County because the prices were. In Alameda County is the more affordable at $9,500 a month for mortgage payments. Here's the actual data, so you can come and look at the data in Alameda County, San Mateo County, in Santa Clara County, or Silicon Valley as a whole. You can see that the number of new listings coming on the marketplace is dropping down fairly significantly. The active listings is dropping, the number of offers is dropping, but the days of unsold inventory is essentially unchanged. Now we're leaving Silicon Valley and we're talking about the Greater Bay Area. Silicon Valley is one of the 5 regions. The cities is another. The North Bay is a third. The Central Valley is a fourth, and the fifth is the Central Coast. Here, we're going to start off with the data. You can see that Santa Clara County and San Mateo County very close together. Marin is the most expensive county still by only $33,000, doing my math. And San Francisco is actually less expensive than both San Mateo County and Santa Clara County. Here are the number of active listings in each area. You can see all 5 regions are dropping. The Central Coast is the most calm out of the areas. It's more mellow. It doesn't get impacted by the holidays as much. You can see if just by looking at the trend, the blue line is sort of a sine wave where the purple line has these big valleys along with the North Bay and San Francisco. That just shows you clearly that each county and each micro market has its own characteristics. And to do broad brushes, you miss those characteristics that are unique to the given micro market area or countywide area, which impacts what you should be doing. Here's your days on unsold inventory. Takeaway Silicon Valley is the fastest, Central Coast is the slowest. The other 3 are grouped fairly close together from 49 to 54 days, depending on which one. Here you're looking at the time on the marketplace. This is the easier to understand metric. How long is the long typical seller taking to sell? 24 days is a big standout in Silicon Valley. You can see that the Central Valley is next at 32, and then the remaining areas are between 42 and 53. Frankly, you got 42 and 46 in the slow area. As the Central Coast at 53 is probably a better way to read that data. Here's the average price reductions. The San Francisco area is taking the most price reduction. Now, this is San Francisco and Marin. If I had San Francisco and San Mateo together, they might be taking the biggest, but that's not the way the data is grouped. Then followed by the Central Coast, followed by the Central Coast, followed by the North Bay, and then you have standouts of the Central Valley and Silicon Valley. Silicon Valley and Central Valley are taking by far the least price reductions, and Silicon Valley is doing the best, followed by Central Valley. And I think what you have going on is a lot of people fleeing to the Central Valley, causing that market to come up. And we had this back in the, I think it was around 87. I have to go back and think a little bit, but lenders actually stopped doing loans for people that had jobs in Silicon Valley that were living in Central Valley because there was a huge wave of foreclosures, and they were called commuter foreclosures. Here we're looking at the seller price reductions. You can see in Silicon Valley, 1 out of 5 sellers takes a price reduction. But in the other 4 regions in the Greater Bay Area, 1 in 3 sellers is taking a price reduction. Silicon Valley, a lot fewer sellers are taking price reductions in Silicon Valley than elsewhere in the Bay Area. And even within Silicon Valley, that's going to be much greater in San Mateo County than in Alameda and Santa Clara. Now what we're doing is looking at the magnitude of the buyers coming in and overbidding. Silicon Valley is the most at 4.5% above asking price, followed by San Francisco at 3%, followed by the North Bay at 1.1. And here's Central Valley, even though it was second on marketing time, it's fourth on overbids, and I believe it's because people that are going to the Central Valley are doing so typically for affordability. So even though they may be willing to overbid, they're overbidding by much smaller dollar amounts or much smaller percentage amounts. And Central Coast is actually below the seller's asking price, and you can see the significant shift in the Central Coast coming down. All of them, you basically can see the peak was sometime, it's clearer on the ones that are peaked more. Silicon Valley and the San Francisco was more of a plateau over the summer months. Here's the frequency of overbidding. You have the most overbidding in Silicon Valley, followed by the San Francisco, followed by the North Bay, followed by the Central Valley, exact same order as the magnitude, and the least amount, only 1/3 of the sellers are getting more than their asking price in Central Coast. You go from 1/3 to almost 2/3 between the local Bay Area. Here's the greater appreciation. Very noteworthy that the city, San Francisco Marin, has the least appreciation, basically 37% appreciation. North Bay is next, all the way up at 59% appreciation, a huge jump. But the Central Valley has the most appreciation at 81%, Central Valley and the Central Coast are basically the same, and I can't read it, but it's very close to 70% appreciation since 2015. A large variation, and if you look at it, they were all very similar until the pandemic struck. And once the pandemic struck, there was a huge change. Not only does it make sense that the change that we're seeing is pandemic related, the timing relates to the pandemic. I believe that the change that we're experiencing is pandemic related and not interest rate related, which has nothing to do with why only 2 counties out of the 9 Bay areas that they were talking about were impacted. Here's your payments. So San Francisco, Marin's going to have the highest payment, followed by Silicon Valley, followed by the Central Coast, followed by the North Bay, and the Central Valley has the least. Here's those estimated payments. It's going to be the exact same order because everybody goes through the same formula to get the payments. It's just in case you want to see what your payments would be. And with that, we've been talking about Silicon Valley real estate marketplace, followed by the Greater Bay Area, which is 13 counties, 5 regions, week number 49. If you want to look at any of the YouTube channels, they're all archived. That's the long handle, youtube.com/ Silicon Valley real estate data, or you can type in the tiny URL, green URL, which I call my root URL. If you add in the year 2023 to the green URL, you get to the Saturday morning presentations at 9 o'clock. If you add in the letter H in the year, month, day code, you get to the current handout. It was up about 14 minutes before the hour. My goal is 15. I'm Richard Calhoun with Creekside Realty. My contact information, working with buyers and sellers in Silicon Valley since '81. Happy to work with any of you. And let me see if I have any questions. Not seeing any unmuted mics. Have a great week. See you next week. Take care. Bye for now. Happy holidays.